how you can make sure that your real estate investment is profitable.
Now, most people are going to just rely on appreciation. So an appreciation is 100% an amazing thing that it happens to homes as long as you buy in the right area where the home is taken care of. It's going to grow in value over time, which is many people rely just on that. But understanding these three other things, which is going to be your ROI, your cash flow, and your taxes, really kind of helps you to really understand, is it a good deal that we're finding? And it makes you just a more informed person.
Exactly. As my wife said, really the appreciation is something that happens gradually by having and is consistent in real estate. And then what we wanted to dive in, really understanding the ROI or return on investment first in real estate, and how exactly benefit your future investment
now,
to be secured and benefits.
ROI itself is a measure to evaluate the efficiency on the investment.
Exactly.
So how much money your rental property is generating relative to its cost. It is not the factor that is going to make or break a deal, but you have to understand it so you can understand, is this going to build over time? Am I going to get a good deal or not? And you understanding your ROI is the first step.
Exactly.
More.
Therefore, if you wanted to break it down that is digestible, sorry for my voice, the ROI is really what is you have gained from your investment minus your cost of the investment divided by the cost of investment.
So already that's going to be a negative number, right? And it's okay that it's a negative number because it's, again, something minus the cost divided by the cost. That's negative all the time.
Exactly. Therefore, if you wanted to break it down, that's something that is digestible, we can give you a number, actually calculation that you understand it better.
Right.
Okay. Therefore, imagine that you purchased a property, a single family home for $200,000 and you spend an additional of $50,000 to renovate that property, like for example put a brand new roof or AC, flooring, you name it. You spend capital of $50,000 and now you are getting $24,000 gross rental income for a year for the whole 12 months.
That's $2,000 a month.
Exactly. Now what we wanted to do, we wanted to use the basically a simple calculation. Therefore, you get the gross of $24,000, which is your gross of an investment, minus how much it costs you, $200,000 plus $50,000, which brings us to $250,000. And you divide it by $250,000, which brings us to minus 0.9. No? Therefore, what it means that this number.
Obviously it's a negative number. It's just showing you how the rental ability is there. So you can see, obviously if you rented for 10 years at $2,000, you're in a much different situation. It's 200 minus 250. Now it's a much lower number. So you can see from this number how long you should hold on to the property for, how to take care of it in order to really see before you sell it with an appreciation, how much you put into it as well. So it's really just for you to understand how much is being put in so you can calculate your math.
Exactly. And also there's a simple formula that you can do that how many years it takes you to get all that money back. Now, the important thing is also beside of the ROI.
Before you get into cash flow, let's do our introduction. Let's hit it. Guys, Alan Victoria, welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now tell me about cash flow.
Therefore, another thing that we wanted to talk about is really cash flow. And many people, they ask, what is the cash flow is? Really is money that is going in and out of your business. That's what it calls cash flow, if you wanted to put it in a simple language. And for rental property, what is that?
It's going to be your gross rental income. Let's just make up a number, $2,000. He's going to give you better. Minus your operating expenses. Maybe that's 10%. Maybe that's $200. Minus your mortgage payment. Maybe your mortgage payment is $1,700. But so it means you're only getting $1,000. He'll give you different numbers in a minute. But even if it's $100 a month that you're getting in your cash flow, but you're really banking on that appreciation factor, you're banking on other factors, it can still work out to be a good deal. So don't let cash flow alone be your guide. Use it to understand your math. Is it a good deal? But don't let that be your only guide. Tell me more math.
Exactly. Let's say you get a gross income of your rental income $2,000 per month, and as my wife said, the operation, let's say, is 500 for sake of the calculation, and your mortgage is, for example, 1,400. Therefore, $2,000 minus 500 minus 1,400, really you get $100 a cash flow that for this scenario.
Now, this is something that can be alarming. If you are imagining it's going to appreciate over time, if you're thinking you can get more rent over time, then these are factors to come into play as well, because you're still in a positive net monthly cash flow. So that is still a good thing. It just has to depend on other reasons for you to do it.
Exactly.
So I would say know your math. And that way you can make informed decisions based on math and not look for the unicorn. Don't be looking for the $800 cash flow right into your pocket every single time.
Well, it could happen if you come with more cash instead of using all mortgage.
Absolutely. But that happens over time.
It happens over the time. And that's why if in these cases, if you don't have enough cash to pay as much as you could for the price of the home, then we're going to talk about the tax benefit, which many people, they don't know about that how that tax benefit really helped them at the end of their story.
Now,
how's that tax benefit?
Tax is going to enhance the value for, don't forget, a really brief history on taxes is that we didn't really pay taxes in America till the 20th century, to the beginning of the 20th century.
1912.
20th century.
Yeah.
And then it's now the 21st century. We've been paying them for 100 years, but not everybody pays the same amount in taxes. Landlords typically are going to look at it as a business, and most people are going to have deductions of mortgage interest, depreciation, repairs, property taxes, and we're going to just go into a little bit more detail of what those are. So what is the interest on your mortgage?
Therefore, the first thing that even the normal home buyers, they get is the interest. No, you're paying with the bank or that financial institution an interest, and they sent you at the end of year those that you can deduct from your tax. And what is the second one?
The second thing is depreciation. That is really more for homeowners who are renting it to other people. The cost of improving and repairing the property, instead of taking one large deduction, you can deduct it over several years. So you can kind of take it as a minus, so your taxes are in better position, so you're paying less taxes over time. Another thing to talk about is repair. What is that? General repairs, general maintenance.
General repairs and maintenance also can be deducted
as long as they're ordinary,
necessary, and reasonable in amount from your tax. And let's talk about a number, no? Because we throw at you a lot of things, but we wanted to give you a number. Let's say you paid already $12,000 mortgage interest to the bank, no, for the property that
you're going to deduct that on your taxes,
and you got to deduct in tax. And then we said for residential, we have 27.5 years of depreciation.
Or you can do it all at once.
You can do it all in once, or you can use it every year for that. And let's say you had a $10,000
HVAC, $10,000 HVAC issue.
10,000. No, I'm talking about property depreciation. Right. That's nothing to do with HVAC. $10,000 for this year depreciation based off that formula.
Depreciation is the cost of buying and selling or improving the rental property. Yeah. So an HVAC is a good example.
But we were talking about repairing and the maintenance.
Anyway, so $10,000 off repairs, and then $2,000 in regular repairs for other things. So that HVAC minus the $2,000 of other things can be about $24,000 you take in taxes this year, or you could do 14 this year and then 10 dividing it over 27 years or 5 years or however you and your accountant want to do it. Again, we are not accountants. We are not tax experts. We just see what people do on the other side. So we are giving this information so you can be informed.
Exactly. Therefore, in conclusion, really, as we said, we highlighted the calculating how to use the ROI, that you need to be mindful about how you get the your mortgage monthly payment and how it can basically play in your ROI. Then we talk about cash flow, that how it goes in and out of your business for the real estate investment. And the third thing, we talk about the tax benefit, that how you can claim it on your tax even we are not a CPA. No?
So if you are thinking about real estate as an investment, as a home ownership, we would love to talk to you more in detail and really break these down with you on individual homes that we're seeing in our market right here, right now. So please go to alandvictoria.com. We are very excited to be
a real estate agent that every day help with the normal home buyers and investors to help them to achieve their goals.